The purpose of Wealth Talk is to educate, inform, and hopefully entertain you on the subject of building your wealth. WealthBuilders recommends you should always take independent financial, tax, or legal advice before making any decisions around your finances.
Hello and welcome to another episode of Wealth Talk. This is episode 21. My name's Christian Rodwell, the Membership Director for WealthBuilders, and I'm joined today by the founder, Mr. Kevin Whelan. Hi, Kevin.
Hi, Chris. How are you doing today?
Excellent, thank you. So today we are on to Pillar 3, which is all about investments.
Yeah, pillar number 3 is really as big as the pension pillar, because if you think about it, what is an investment? I mean, it's a huge area where people kind of park their money, don't they? They sort of put it in some market or other, whether it's the market for cash, whether it's the market for government bonds or national savings. It's the stock market, which is the biggest market of all, of course. But as we'll discover, Chris, as we go through this concept of markets, there are many markets. And just as you can buy groceries at different prices in different markets, we'll learn very much that it's really important to understand, how markets work. Not a detailed dive. It's not important to dive so deep when you're trying just to understand broadly how markets work. Remember, the key to the wheel of wealth is a bit of education to be able to ask better questions, not all of the education. So this session will not be a complete focus on every single aspect of every single market. It would be too big a topic, Chris. We'd still be here 3 weeks from now. But I think it allows us to dispel some myths. And as I said on the last podcast, Chris, we'll shoot a couple of sacred cows as well, things that I just think fundamentally are misunderstood and badly taught. And if truth be told, really people are misinformed. And they're misinformed for a reason, because those people who dispel the education is really salesmanship in disguise. It's people being sold a line as opposed to doing something which they know to be good for them, which is why, Chris, I would like to use the title that almost all investments are C.R.A.P, Chris.
Yes, I'm sure that title, it caught a few people's attention, I'm sure, who are listening right now. So what do we mean by this, Kevin?
Well, look, Chris, I'm not having a go at every market in town, of course not. It's a pillar. So you build your wealth on pillar number 3. Invariably, though, you can't build your wealth well in pillar number 3 because you're relying on a market that somebody else has control over, or the world has control over. So you don't really have that control. So as we get into other pillars, we'll realize we have got the ability to drive value, to bring more of our own wealth dynamic, more of our own skills, and more of our own time and collaborations, all those forms of leverage. We don't really have too much to bring to the investment pillar, because almost in all cases, the money's parked. It's given to somebody or some organization for them to do something with that we kind of hope works. And, so there's a massive challenge when people just hope that things will work. And I'm not sure that's a great basis on building wealth. Now, the stock market isn't a bad place, for example, for having some wealth invested once you built it, but it's not necessarily, in my view, the greatest place to build the wealth if you're simply not able to add control. You can't wake up today and say, I'm going to do something today that will change any market at all. You can't do it. We don't have enough money as individuals to do that. So we're very much relying on how a market works. And I would like to say there are 4 key things that anybody who's investing in a market should be aware of, and that's the acronym, Chris, of C.R.A.P. So I'm not saying all investments are crap. I'm just saying here's an acronym, here's something or a mnemonic, nice and easy to use, that you can create as a filter before you make any investment. Okay, so we had a bit of fun with it, but let's get serious now.
Okay, so kick us off with the C then, Kevin?
Well, if you understand that I said you can't control the market, what can you control? Well, the only thing you can really genuinely control is the cost of investing in that market. So that's the entry cost, the running cost, and the exit cost. And, there are always costs when you buy into anything. And of course, a good wealth builder is looking for value. They know there's a cost to do anything, but they want value from that. And that's how the stock market and any market really should be viewed. What is the cost of entry into the market? Now, of course, entry into things like cash, if you're in the bank, for example, the cost of entry is not high, is it? I mean, you would argue it's probably zero. But it's the opportunity cost, isn't it? So in economic terms, and that's my background, Chris, there's the cost that is always got to be considered when looking at the true cost of anything. And what's the opportunity cost? In other words, what can you do instead that will give you a better result, a more leveraged return that helps you towards building your wealth? Because all of the investments, the reason why people invest isn't to invest. They invest for some kind of outcome. And that outcome almost always is measured in terms of what's the return on the investment. As we call that an ROI, don't we? What's the return on my investment? Well, the return on your investment is always, what's the gross return? What's the total return? Minus the costs of being in that. And you can never control the total return in any market, as I've said all along. So the only thing you can control is the cost. And I think we'll hear, won't we, from some of our other partners or from some of our students that one of the big things that they focused on is really minimizing that cost of entry, minimizing that running cost, and minimizing that exit cost or conversion cost. I'll come on to conversion, Chris, when we get into the A part. Remind me of that, if you will, in case I forget, which is this idea then of, if you recognize that billions and billions of pounds, just like pensions, is really passed into the hands of an industry. And the industry have a view that is, the more that they can make the costs look low, the more likely it is that people will simply ignore them or kind of cast them to one side as if they're not worth worrying about. And I'm not sure that's the right approach. So, Chris, I think I've mentioned this before on a podcast or two. The average running cost, even forgetting entry costs for the minute, but the average running cost, which is a much longer term cost for people holding their money. So let's say someone's investing money in the stock market and they hold that money for the long term. Do you know what the average cost of that is when you look at who's holding the asset? Because we don't hold the shares anymore. Who's holding? That's called a custodian. Who's managing the money in terms of who's making the decisions about what investments are made, and who's making the decision or the interface between the investor and accessing that money, in other words, an intermediary. You know what the average cost of that is for pension holders and investment holders in the UK on average?
I would go for around 2%.
You've been listening to a good. Now, I don't know about you, Chris, but if the average cost of holding money is, say, 2%, and let's say your average return was 6%, see, 2 doesn't sound a lot, especially if you break it down so well. The custodian cost, or the market cost, the supermarket is 0.25%. The advisor cost is 0.5%. Don't sound like a lot, does it really? But when you think about if the gross return and the fund manager, of course, and we talked last week, didn't we, about one fund manager who got it horribly wrong for his clients but pocketed a nice bonus for himself. And so this whole area makes my blood boil a little, because it kind of gets people into a process of thinking that this is super, super complicated and only experts can do this. And therefore you should put your hands, or your money rather, into the hands of experts, and their costs are reasonable. And in my experience, they're not reasonable at all if you measure 2 as a percentage of 6, say, or even 2 as a percentage of 10, you're still paying a quarter to a third, and in some cases a half. I mean, look at the people who are holding money in retirement, where their attitude to risk is likely to be lower, therefore their returns will be lower. But if their costs are similar, they could be paying 2% to get 4%. And that's like 50% of your money going to the industry instead of into the hands of the people who should have that money and should have their wealth and their security in place. So, I'm not really a fan of a market-based approach that just simply delegates the money to a third party. And I'm not saying advisors or the industry's got bad intentions. I'm definitely not saying that. I'm just saying that there's another way you can control your cost. You can access costs much more cheaply in almost any market, and in some cases free, or a fraction of 0.1%, 0.2%, really, really very low cost if you pay attention to how you can access. And the running costs can be very low too, particularly if you're looking into investments where there aren't really any running costs at all. And in some cases, the running costs of the stock market can be very, very low if you know how to buy into the marketplace as a whole at a fraction of the cost it would take if you use the intermediated service that is more often used. So I think we'll have some of our speakers talk a little bit more about that. I think you've either got those lined up, I think, Chris.
We will do. We will do probably in the next episode, yeah. And I know that you've said on previous podcasts, Kevin, if you're a wealth builder and changing that mindset from that of the employee perhaps to the entrepreneur, that you really have to be in the business of money management. And as you say, it doesn't mean studying up loads of finance books, but just understanding the basics of money management. And obviously cost is an area where perhaps some people just accept, that's the way it is, but it certainly doesn't just have to be like that, does it?
No, it's not the way it is at all. And I think anybody who's seeing the growth of the kind of online supermarkets, online comparison sites, these sorts of things, it's very easy to get access to markets quite cheaply through the use of ETFs, exchange traded funds, much lower cost way of being able to buy into the principle of a marketplace doing what markets do. And all of the evidence is, Chris, and we can provide the evidence, but there's so much evidence that the relationship between total performance and cost is absolutely in alignment. In other words, the higher your cost of running your money, the lower your performance will be. So you don't get more money by paying more for it. The evidence is that's just not the case. Yes, there'll be a few exceptions where fund managers will outperform the market, but not consistently so. And to the extent that I would challenge anybody to want to do that, to think that somebody else, they can choose the right jockey to back a horse, when in fact it's just much easier if you want to be invested in, say, the stock market, then use the stock market to do what it does, which is companies making profit just as an entrepreneur does, and allow those profits to be made and make your gains in the lowest cost way, because the market is so fast and it's so instantaneous, and when it comes to the speed of things, there's no way any individual can really outperform the market. So anyway, that's a view I hold. Keep those costs as low as possible. So use ETFs, use trackers, use passives over actives. In general terms, if you want to, we know that some people want to be active themselves, and that's fine. But that's you making a decision. You want to learn how the market works in more detail. That's not the purpose of this podcast, but you can get into that. And those people who do that, who get the right education, get the right support, make the right connections, test, do due diligence, then they can do a better job. But they're focused on it themselves. They're adding value for themselves in a different way, which is, when you're trading in the market, when you're looking for small pockets of opportunity, or you're holding something with good intrinsic value like gold, silver, or other precious metals and things like that, or just long-term stocks and long-term holdings of the Dow or whatever it would be. And then you're learning a little more how to trade and how to make gains because other people are trading, so the use of options. But that's, again, beyond the scope of today. But we know lots of good people who teach that for those who want to know more.
Sure. So let's move on then, Kevin. Should we have a look at the R?
Yeah, well, R is always understanding risk, and the second ROI, it's really important to think about. We talked about return on investment, didn't we? But probably the more important one is the return of your investment. What's the risk to your capital? Because there's no substitute, there's no compensation if you lose all your money, being able to get it back again in the future. You'd be a bad investor, you'll be hurt, you'll be damaged, and you'll lack trust in yourself and you'll lack trust in others. And consequently, it's a really hard place for people to be. So you have to be able to manage risk, which is the reason why we say, building wealth in multiple pillars makes more sense than putting all your eggs in any basket, even if it's a stock market basket. But obviously one of the ways the industry encourages people to minimize the risk, and definitely I can see the value in it, is the principle of diversification. And that principle is, it's always framed out of don't put all your eggs in one basket. And we hear that all the time. And nothing wrong with the principle. But the problem with diversification, it makes the assumption, of course, that you can't add any value. And in the stock market, it's probably true for the most part, you can't. So therefore, just understand how the market generally works over the long term. And for those of us who study these things, I'm more than happy to have another session, Chris, maybe a webinar, because you need graphs and charts and things. But just to show there's like an expectation of a risk reward payoff when it comes to investing in the stock market. So stated differently, whenever you invest in the stock market, you'll always go through some kind of assessment, particularly if you're using an intermediated service like an IFA or a broker. There'll be some kind of process that says, what is your attitude to risk? And that attitude to risk will normally play out in either a very simple questionnaire or some form of questionnaire. And that questionnaire normally assigns the individual a sort of a score on kind of 1 to 10, something like that. It can be different things, but let's say, 1 to 10, with 1 being low and 10 being high. And by studying these things, understanding how the markets generally work, the lowest risk funds will have predominantly cash, and the highest risk funds will be higher risk equities, for example. So there's always a sort of a payoff. And what we've discovered by looking at the numbers is really there is a relationship between the two, but you don't get if you take level, say, an average return or an average risk score on a scale of 1 to 10, say 5 being right in the middle. And let me be simplistic just for the sake of this. So I'm not saying this is true or accurate, simply illustrative. If the average expected return from somebody investing in a middle risk portfolio would be 5, then that'd be 5%. Then if they double that risk, they don't get double the return because you're taking a much bigger risk of a potential of a fall. So, and we can see this very clearly when we start looking at some of the charts. So it's really important as you're looking at risk to understand the risk in the market, but to understand also you don't need to sit and just watch the market rise and fall. There are some things that you can genuinely do to de-risk yourself as opposed to simply allowing the market to ride its ups and its downs, and you never know how you're really going to feel until at some point when you need that money. And I'll get onto that one when we talk about the accumulation. So the answer to this process then is what are the things I can do that will help me minimize that risk? And one thing you can do is, for example, you can lock in profits. So if you're investing in the market and you make money in the market, you can bank that money and invest it in something that doesn't work in the same way as the market. So, for example, say you make some good gains, you have a really good return, you've invested 10,000 and you made a 10,000 profit, or you've invested some money and you made 10,000 profit. You could leave 5,000 in and take 5,000 out and do something different with it. You could invest it in an alternative market, crowdfunding or lending, or some of the other things we'll maybe get to either in this podcast, Chris, or the next one, when we talk about alternative markets. So you're sort of banking as you go, and then as you take money out of that market, you're counter-correlating. Correlating means the way things work together. If you put it in a different market, then it's not going to work the same way as the market you were just in. So you're almost building yourself a level of risk protection. Is that making sense?
Almost like a hedge, would you say?
Yeah, it is a hedge. The other way you can look at this is very simple, and I'm sure one of our trusted people, Jeremy, will talk more about this, which is the way you can lock in gains or minimize your losses through something called stop loss. So instead of, if we watch the market, and let me be very simplistic again, Chris, if you see how markets rise and fall, they tend to rise very slowly and fall very quickly. So, if you can picture that in your head, a very slow, steady rise. Yes, there are a few bumps in there, and then it kind of falls dramatically. And we've seen that many times. And the big danger is that dramatic fall. And if you take a similar imagination, if you imagine that's going to happen, it's going to happen sometime. I don't know when, but it's going to happen. It's happened before, it's going to happen again. And you looked at that and you thought, well, hang on a minute. If I know I'm going to have a dramatic fall and a dramatic fall will hurt me, how would I protect myself from that fall? Well, if you imagine that fall as a line, seeing it like a cliff face, and you imagine you were a mountaineer climbing that, what would you be doing to stop yourself from falling all the way to the bottom, Chris?
Yeah, you'd be tapping in some kind of harness or some kind of secure points where you couldn't fall any further.
Right. So you might fall a little bit, and you might be hurt a bit. You might be uncomfortable for a while, but you wouldn't be devastated. And this you can do in the stock market, and this is stop losses. So you just very simple concept called stop loss. Sort of does what it says on the tin. It says if the market, if you believe, if the chance of a market going up, if the average is 5%, and in a good year you make 15, and in a bad, or say 20, in a bad year you'd lose 15. And we can show these tables separately, I think, Chris, to bring them more to life. But if we imagine that, then if the market was likely to fall by 15% or 20%, and you think that's just a possibility, you could hammer in a little harness, not a harness, but an anchor that says, well, if the stock market falls by 10% or more, I'm out. So you can have the market, you put an order in to get you out of the market. So yes, you might lose some money, but you're limiting your loss, hence the word stop loss. So these are just some of and they're not difficult to learn. I mean, these are so simple to learn, and yet I don't think I've met a fund manager or an IFA yet that talks about this, because one of the things that kind of worries me about it is these funds always have names, and when you've got a fund with a name, like a UK equity fund, you have to invest in UK equity funds. So what happens if UK equity funds fall dramatically? Your fund is called the UK equity funds. You've got to hold UK equities. So where's the counter correlation? Where's the stop lossing? These things are not happening when you just buy into a fund, if you see what I mean.
Yeah. It's probably worth mentioning, I know typical investment, you make money when it goes up, but if you do learn some slightly more advanced strategies around trading, which you've touched on there, then actually you can make money in a falling market as well. So you can catch some profit on both sides.
Beyond the scope of today, but and also you have to learn very much how those things work. But stop loss is very simple. That can be taught. Certainly, we talked about in a previous podcast, Chris, if somebody's serious about the stock market, they could make good stock market decisions and get all the necessary education, support, and connection they need to learn this within 30 days.
Yeah.
This isn't life's work. This is a 30-day time frame that someone could learn enough to minimize their cost and minimize their risk.
Talking today about why most investments are C.R.A.P. We're halfway through, Kevin, so let's look at what the A stands for.
Yeah, this is an interesting one, Chris. And this is the A stands for Accumulation Model. What the hell does that mean? Well, it means, when you buy into an investment and you have the meeting with your IFA when the markets fell, like they did in 2008, what do they say to you when those things happen? It'll all be okay in the long run.
Right. Okay. Yeah. Ride out the market. Right. Just hold out, and it will bounce back at some stage.
That's exactly right. So this is a model known as the accumulation model. You simply just hang on. So they call it a buy and hold model. I call it the buy and hope model. You buy funds and then you hope it all's going to work out. Because you see, the key thing about wealth, and as you think about this and really reflect on what we've been teaching so far, wealth doesn't come from accumulating money and then at one date in your life you suddenly convert that money into cash flow. You create cash flow as you go. So the essence of wealth building is owning assets that flow cash, not owning assets that grow or fall or stay the same in any year, but they provide you with cash flow. And this isn't a model that's being taught. So if you think about the way most investments work, is they buy and hold for the long term. And then at some date in the future, the money is then converted into money that individuals will spend.
Yeah. I mean, I was just thinking when you were saying that, Kevin, it hasn't worked out too bad for someone like Warren Buffett, has it? That buy and hold strategy.
No, the buy and hold strategy for Buffett is brilliant because his business does that. So, his business is there to make money in the long term, and they've got a very strong view about how they do that. So, and also they're buying institutionally, they're buying for the long term, sure. But one of the biggest ways Warren Buffett makes money is not through the buying and holding of good equities, is by trading, is by allowing the trades to take place. So he's got such a high stock holding of what we call a position on so many different high quality stocks that, he generates premiums by essentially renting out his stock to other people who want access to it. So it's like, having a property. So think about it a different way. If you had a piece of property, do you accumulate the value? Would you keep a property empty just to accumulate the value? Or do you create rental because you want to create an income?
Yeah, absolutely. Second option.
Right. So it's the same with investing. And Warren Buffett knows this because he makes millions and millions and millions every year on the trading of options, where he's basically renting out his stock. So because he knows he's got great stocks, so he's holding them. And this is another way to think about it, by the way. This whole process of not just accumulating for the sake of holding on to somebody else's model. There's a way that you can accumulate that is a reflection of you. And I can talk about that in a minute. But just before I finish on that, the important thing about wealth building is about cash flow. And the challenge with the market is very difficult to create cash flow unless you're doing something to create value for yourself, as Buffett does. So the position you can take with cash flow is much more difficult. And that's why it's not really a great way to build wealth. It's a way to manage wealth you've already built. Because it has got some great value in terms of it generally provides enough value. You can buy into the market cheaply. You can protect yourself on the downside. You can make some money if you learn how to create cash flow in the upside and the downside through trading. And of course, it's very liquid. Whereas other assets that we get into, other pillars, are less liquid, aren't they, Chris? That's less liquid in property, for example. It's difficult to sell property quickly. It's difficult to sell a business quickly. It's difficult to create joint ventures, then exit them quickly. So one of the huge value factors in the marketplace is it's highly liquid. But you see, most people don't need that liquidity. And if you're investing for the long term, you don't need the liquidity. So you can tie your money, into a different philosophy, which could be you turn your investing into a reflection of you. So what do I mean by that? Okay. So, Chris, I'm a wealth builder. And one of the things I believe which is really important in the wealth building process, particularly with business, which is my favorite asset, but in any of the assets really, is this idea of income and cash flow that recurs. So recurring income, recurring income, recurring income. So if that's who I am as a person, why would I invest in something that didn't do that?
Only for, I would say, that diversification, but then that would be a smaller element, certainly probably not your primary wealth building pillar or focus.
Yeah, no, okay, that's a good point. It's not where I was aiming at. Maybe I didn't explain myself well, so let me try again. If, as a person, I come from a place of high recurring income, then if I choose a percentage of my holdings and my wealth to be in the stock market, and I do have some money in the market, then I could choose to invest specifically and in a low-cost way in companies that reflect my beliefs.
Mm-hmm.
So those companies that have high degree of recurring income.
A dividend, do you mean?
Yes, or buying into companies where, there's a natural expectation that the clients will and their customers will buy and rebuy and rebuy and rebuy and rebuy. And then you can buy companies then that do that. So instead of just simply being a reflection in a market, you're saying this is a reflection of me as a person. So, I would look out for companies, and I could do it this way. I choose not to, and maybe it's not good for me to mention what I invest in because that's not helpful, because I'm not trying to give an opinion about me, because I'm very uniquely me. But I have a thought process, and I minimize my time because I happen to have chosen a method of investing in funds that I think is a reflection exactly of who I am as a person. So I've chosen a pathway to invest in the market. And that's very simple and easy for me to say, right, I've got a certain percentage of my money in the market, and I'm holding those for the long term as part of a diversifier. And I know I can cash in and do those things whenever I want to. And whether I choose to stop loss or not doesn't matter. It just means, that's a reflection of me. Well, look at how many different people we've got in our students now. So what if somebody was highly focused around green energy or highly focused around ethics? And you can invest in specific funds, or you can invest in very, very tight and specific ETFs, because ETFs are so easy and low cost to run. Instead of being a giant fund, like the FTSE, for example, where you can't really ethically control that, you can zero in on something. And with an ETF, you can choose an almost bespoke into a very niche sector that is a reflection of you. So, the whole principle of investing is for it to be a reflection of who you are. When you say you're invested in something, if you take the word investment out the money side, if I say I'm heavily invested in the principles of wealth building, is that true? It is true. I'm invested in the principle. So it means it's fundamentally part of my DNA. So why wouldn't I invest in the same way? So if you have very strong views, very strong principles, then you can choose to invest in a way that reflects them, so it becomes part of who you are, not something that's forgotten or something that you give to somebody else and is part of their business and their mindset, which may not reflect yours at all. Just making sense.
And yeah, absolutely. We travel on London Underground, and all the time now I'm just peering up on the advertisements inside the tubes and seeing very much these examples of all different niches where there's a new app where you can invest into this area. So I think with technology now, it's just opening up that market so much more, isn't it?
Absolutely. And I think what's brilliant about technology is it's allowing people to choose into something very specific and niche for themselves in a way that didn't happen. And you can't do that. Let's say, most people will access their investments through their ISAs or through their pension fund in workplace. You don't get this sort of option, but you can choose so many different pathways to invest that you can have fun, and therefore it doesn't have to be something that's, I hope it's better next year.
And also the starting point is very low cost for these platforms now, isn't it?
Remarkably low. And when you're buying things on very, very low cost, and you're investing in what you want to invest in, then and you're investing some of your money for the longer term, and of course you can also access these things regularly through saving money that you're making either from rental property. If you can combine the pillars, so we have lots of clients who've got rental income, and then they reinvest the rental income in something that's counter correlated to their property portfolio. See how all these things just interconnect, Chris? And it isn't difficult. It's just the thinking that's difficult, because most people come from a place, not of education, but being told this is how investments are made. This is what you do. And it isn't what you do, just it's what you've been told is done, because it perpetuates the money and the accumulation, buy and hold theory in the marketplace. And I'm not sure that's the right place for true wealth building students.
So we've covered cost, which was the C. We've covered risk, which was the R. Accumulate just there. So that leaves us with the final P, Kevin.
And it's process. The process of doing these things is so simple. It really is remarkably simple. As soon as you start just to think about, well, how do I want to invest? What percentage of the money do I want to invest? What are the different markets that I could invest in? What do I like about them? Say, we're talking today predominantly about the stock market. I think we've been talking quite a while, so we probably have to do alternative markets next time. But if it's just the stock market, it's, do I want to invest passively? Do I want to invest in a low-cost way? Do I want to invest in a way that reflects who I am? Once you know these things, and we can help with that process, once you've got a few things, a few kind of parameters, do I want to invest with stop losses or not? Then you can learn that process within 30 days and run your investments for a fraction of the cost that you pay a fortune for someone who teaches you this, doesn't actually teach you, just does it for you once, sets it up once, and then gets to plug a siphon into your funds for the rest of your life. I'm not sure that's right. Why not learn? Wealth building starts with education. Why not learn a little bit about yourself, reflect on who you are, learn a little bit about the way you can access the market, listen to some of our students, how they're investing. Certainly don't invest like me, invest like you. And you are uniquely you as the listener. Choose what you want. And if you want to be in a market, choose the best way and the best pathway into that market, and let us guide you to the lowest cost way of getting in, managing the process, and then getting money out when you need it to invest in other assets, or to simply continue to keep your whole wealth in balance. Because once you've made that decision, say you decide to keep 10% of your money in the market for the sake of a number, if things do really, really well, then you can rebalance that. So, you've made some money, you've now got 12% in the market, you can decide to bank that 2% and put it somewhere else, in a different market, or in one of the other pillars, or to pay for the education for you to learn about a new pillar. See how all these things are so interconnected, Chris? The whole essence of this is to not feel isolated and on your own, or at the mercy of someone else who's just saying, this is the best way to do it, trust me. That's not the way to do it. The way to do it is to stop, to think, lowest cost, lowest risk. Don't focus on just the accumulation model. Think about, moving money to different places and seeing it balanced in your overall wealth plan, and learn a process that we can share and teach with you, certainly in less than 30 days, that you'd be confidently able to start investing your money in a way that is so much more better value for you in the long term than giving it to so-called experts and paying them for the rest of your life. I think I've said enough.
Well, if there was one word I think that sums this episode up, I think it's empowering. And I know it's a word close to your heart, Kevin, but it really is empowering people to just take some control, to just understand a little bit more about this subject area. And the benefits are huge if someone does that.
And it'd be great to hear from, more of our students on how they're doing that, so that the perspectives they share with each other, will help you see things you don't see on your own. Because one of the things I'm noticing as we get more feedback from our community, Chris, is how lonely people are. I don't mean lonely as in isolated, from other people, but in their wealth building. It's almost they've got to make all those decisions in their own head. They don't have the true trust of people around them to help them just decipher what's right for them. And that's where I'd start with all of this, is start to work out who you are. And then once you know who you are, you can choose the way to build wealth that reflects you and not being told what to do. Yeah.
Absolutely. We want to say thank you so much to all of the people in the Wealth Builders community and everyone who's been listening to Wealth Talk, because I know both you and I, Kevin, every week we get comments from more and more people just saying how much they're enjoying listening to the Wealth Talk podcast and, actually taking action, implementing some of these things that we're talking about. So thank you. And thank you to everyone who's been leaving reviews on iTunes as well. We're climbing the charts. We're getting more and more reviews every week. So if you haven't left a review and you're enjoying the show, we'd really appreciate a few moments of your time to just share a few words on there. And of course, if you're not already a member of the Wealth Builders Facebook group, then you can head to wealthbuilders.co.uk/Facebook. And we're over the 1,000 member mark. So come and join the party in there. And both you and I, Kevin, we're in there all the time answering people's questions and keeping people updated of where we're both going to be and where you're speaking at future events as well.
And it would be, in the final words here, I think it would be good to know, well, what would people like to learn? So it's difficult, isn't it, when you're creating content as we are from the heart? It's difficult to know exactly, how do we take this to give the specific lessons to people? How do they want to do that? Because as you've heard, there are so many different ways you can come at this from. So it would just be good to know, yes, if you thought it was useful, great to know that, but then what would you need to know to be able to take action? Because that's the next step. So help us help you, because we know how to do these things, and we've got so many hundreds and hundreds of thousands of different ways and people that we can help give you access to more knowledge. But what we don't want to do is overwhelm you. So when you're ready for the investment piece, if you're already an investor, just take one 30-day period and say, this month, I'm going to nail my investment plan. And then the next month, the execution of it. So within 2 months, you're done. 90 days tops, you're done with what you want to do with your investment. So let us know what you need. Let us know what you want. We'll try and bring that to you.
Great. I think that's a wrap for Wealth Talk 21. Thanks for your time today, Kevin. Really enjoyed that one. And we'll catch up on the next episode.
Okay. We'll be talking about alternative markets, I think, next time, Chris.
I think we will. I'll see you then.
Okay. See ya.
We hope you enjoyed today's episode. Don't forget that we are constantly updating our resources inside the Wealth Builders membership site to help you create, build, and protect your wealth. Head over to wealthbuilders.co.uk/membership right now for free access. That's wealthbuilders.co.uk/membership.